You know that gut-wrenching feeling, right? You see a huge breakout, you jump in, you're excited, and then boom, it just completely reverses on you. It is so frustrating. It's like the market is speaking the secret language, and we're always one step behind. Well, today we're going to learn how to translate it. We are diving deep into volume spread analysis, which is this incredible technique for reading the story the chart is really trying to tell us. So, here's our game plan for today. First, we're going to talk about that classic trader's dilemma. Then, we'll get into the good stuff, decoding the market story with VSA. We'll look at how you can spot the smart money buying and, just as important, when they're selling. And finally, we'll wrap it all up so you can look at any chart and see the whole picture. All right, first up, the trader's dilemma. I mean, this is the core problem, isn't it? We see the price moving up or down, but what's really driving it? Is this move the real deal, or is it just a big fat setup? That's the question that keeps us up at night. I mean, this has to be the million-dollar question, right? Picture this. You see the price just smash through a key resistance level. Your heart starts pounding, the excitement is real. But you gotta ask yourself, is this move being driven by genuine, powerful demand? Or is it a trap? A classic move designed to suck in all the hopeful buyers right before they pull the rug out. Just looking at the price by itself, it's never gonna give you the full answer. And this really gets to the heart of it. Looking at just price action, well, it's like watching a movie on mute. You see what's happening on the surface, but you're missing the whole story. But the moment you add volume into the mix, bam. Now you've got the dialogue, you've got the context, you get the real story happening behind the scenes. Because volume reveals the effort behind every single price move. Okay, so how do we actually read this real story? How do we make sense of it all? Well, that brings us to the main event, volume spread analysis, or VSA for short. Think of this as our special key, the tool that lets us finally peek behind the curtain and see what's really going on. Now, at its heart, VSA is actually pretty simple. It's not some crazy complex formula. We're really just looking at two things on the chart. First, the range of a price bar, the distance from its high to its low. We call that the spread. And second, we're looking at the trading volume for that exact same bar. That's it. It's the relationship between these two things, the spread and the volume, that tells us pretty much everything we need to know. So this all boils down to about 4 basic scenarios. The first two are what we'd call harmony. They just make sense. You see a big, wide price bar on really high volume? Cool, the trend is strong. You see a tiny little bar on super low volume? Okay, the market's just taking a breather. But it's those bottom two, the anomalies, where things get really interesting. This is the juicy stuff. A huge price move on low volume or a teeny tiny price move on massive volume? That's a mismatch, and that, my friends, is usually where the smart money tips their hand. And this isn't some brand new idea, it goes all the way back to Dow theory. Volume confirms price action. This quote perfectly sums up that idea of harmony. A healthy, strong trend should have strong volume behind it. It's when those two things start to disagree, when they diverge, that's our cue to lean in and pay very close attention. All right, so let's get practical. How does this actually help us spot what the pros are doing? We're going to start with the good stuff, spotting the signs of strength. This is all about finding the clues that tell us the smart money is quietly buying up shares. Okay, now this next part is maybe the most important and counterintuitive idea in all of ESA. So listen close. Strength, real professional buying, shows up on down bars. Yeah, you heard that right, on red bars when the price is falling. Now, why on earth would that be? Well, think about it. If you're a big institution and you need to buy 1 million shares, you can't just slam the buy button. You'd send the price to the moon. No, the best time to buy is when everyone else is panicking and selling. You can step in and quietly absorb all that selling pressure. And the classic example of this is something called stopping volume. Just imagine a chart that's been in a free fall, right? It's just dropping and dropping. And then all of a sudden you see it, a big wide down bar, but the volume is absolutely massive. And here's the kicker. The bar doesn't close at the very bottom. It closes somewhere in the middle or even near the high. That is a massive clue. So what story is that bar telling us? It's simple. The public is scared. The news is terrible. They're dumping their shares for any price they can get. But the professionals? They see an opportunity. They step right in and buy everything the public is selling. That huge spike in volume, that's literally the transfer of shares from what we call weak hands to strong hands. It's like they're building a floor right under the price. Now, after a big move like stopping volume, the pros don't just immediately jam the price higher. They're smarter than that. They're cautious.
So what they do next is they test the market. You'll see the price drift back down a little, usually on a narrow bar, but here's the most important part. The volume is super, super low.
The story here is like they're dipping their toe in the water. They're asking the market a question. They're saying, hey, is there any more selling pressure left down here? And that tiny, low volume bar is the market's answer. Nope. All the sellers are gone. We're exhausted. And when the pros see that, they know the coast is clear. They know the path of least resistance is now up. Okay, so let's flip the script, because if we can spot the pros buying, you can bet we can spot them selling too. This is what VSA calls distribution. We're now looking for the signs of weakness. And here's the tricky part. They often show up when the market looks like it's at its absolute strongest. And yep, you guessed it, here comes that second big counterintuitive rule. Just like strength appears on down bars, weakness or professional selling appears on up bars, green bars. Why? For the exact same reason, just in reverse. If you need to sell 1 million shares, you need 1 million shares worth of buyers. And when is everyone buying? When the market's flying high, when the news is great, when everyone is euphoric. The pros sell directly into that excitement.
This is one of the most classic topping signals you'll ever see. The market's hitting new highs, the news headlines are glowing, everyone's feeling like a genius, and you get this up bar on absolutely monstrous volume. But look at the bar itself. It's tiny, it's narrow. The price barely made any upward progress. That right there is a major, major red flag. What's the story here? Well, it's a hidden battle. All of that massive volume, that's a tremendous amount of effort from the buyers. They're throwing everything they have at it. But that tiny little narrow spread, that's the result. Their effort completely failed. And why? Because they ran into a gigantic wall of selling from the professionals, who are happy to absorb all that demand and put a cap on the price. Okay, here's another sign of weakness, and this one's a little more subtle. After a big move up, you'll see the market kind of try to push higher. You'll get an up bar, but the volume is just pathetic. It's really low. This isn't that big climactic battle we just saw. This is the exact opposite. It's a sign that the buying has just fizzled out.
The logic is really simple when you think about it. For a market to keep going higher, it needs fuel, right? It needs demand, especially from the big professional players. So if the market tries to rally and the volume is just anemic, it's screaming that the smart money is not interested at these prices. And you have to ask yourself, if they're not buying, who is left to push this thing higher? And the answer is often nobody. All right, so we've looked at the individual puzzle pieces, the signs of strength and the signs of weakness. Now it's time to zoom out a bit and talk about how we put it all together to read the story of the entire chart. Here is your simple but really powerful VSA checklist. Number 1, always read the background first. A sign of strength or weakness doesn't happen in a vacuum, it needs context. Number 2, actively hunt for the anomalies. Look for that mismatch between the price spread and the volume. That's your clue. And number 3, probably the hardest one, be patient. Let the next couple of bars confirm what you think you're seeing before you jump in. So let's just hammer home these core VSA truths. If you forget everything else, remember these. 1, strength shows up on down bars. 2, weakness shows up on up bars. 3, the news is usually just noise designed to get you to do the wrong thing at the wrong time. And 4, at the end of the day, the market is just a big tug of war between the pros and the public. Your job is to figure out which side is winning. So, from now on, when you pull up a chart, I want you to try something different. Don't just see candlesticks in lines. Try to see the story. See the effort versus the result. Look for the harmony. But more importantly, hunt for the anomalies. Because I promise you, the chart is always telling a story. The real question is, are you listening?